If you want to buy a home, the first thing you should do is go hunting for the house you want, right? Wait, not so fast. Unless you can pay the entire price with cash, you will need a mortgage loan. As a buyer, it is very important to find a good lender and a loan with suitable interest rates and terms. Hi, my name is Coco Tan. I'm a realtor with Keller Realty in the San Francisco Bay Area. I guide prospective homeowners through every step in the buying process. First-time home buyers sometimes ask me, what is a pre-approval letter and what do I need it for? A pre-approval is a preliminary approval from a lender that you will be able to get a loan. Sellers expect buyers to have a pre-approval to show that they are serious and can afford the purchase. You will have a major advantage in negotiations compared to buyers without a pre-approval. It is also good to show to real estate agents so that they know which houses to show you that are within your budget. These days, a pre-approval letter is basically a requirement. To get the best loan, start by contacting multiple banks or mortgage lenders. You are not only shopping for good rates, but also choosing a financial partner. You want a lender that will make the process easy for you and help remove barriers to your approval. Keep in mind that you can apply for pre-approval from more than one lender without any major negative consequences. So, what happens in your first meeting with a lender? You can discuss your loan options and budget. They can even help you check your credit and discuss any issues with it. I will explain credit and credit scores later, and different loan types will be featured in an upcoming video. If you're not sure that you're financially ready to buy a home, you can ask for a pre-qualification before going for a pre-approval. The purpose of this is to get a rough idea of what kind of loan you qualify for and what your budget should be. A pre-qualification is quicker and easier to get than a pre-approval, but less accurate and less useful. You may not be required to provide a credit report, bank statements, or pay stubs. You simply tell the lender about your income, credit, debts, and assets. In exchange, the lender will tell you if you qualify for a mortgage and will give estimates for the amount, loan program, and interest rates. The downside is that it has no actual negotiation value. It's just an estimate, not an approval. For that, you need a pre-approval. It is a longer process in which a lender pulls your credit report and reviews documents to verify your income, assets, and debts. At the end, you receive a pre-approval letter that can be presented to sellers and their agents. Buyers who are confident about their financial readiness can skip the pre-qualification step and go straight to pre-approval. To do that, you should start gathering the required documents. They include the following: proof of income, including your 2 most recent pay stubs, as well as W-2s or tax returns from the past 2 years. Proof of assets, which includes bank statements, investment account statements, or retirement account statements from the past 2 months. Proof of identity, which is a copy of your driver's license, or if you are immigrant, green card, or visa, for example, H-1 visa. And finally, if you have existing mortgages for homes you own, you will have to provide the latest mortgage statement, property tax bill, and insurance declaration page. Why are there so many required documents? Because lenders are risk averse. Not only will they perform a thorough credit check, but they will also analyze all of your documents to dissect your financial situation and history. Specifically, they will verify your employment and either your existing mortgage or rent using a VOE, verification of employment. VOM, verification of mortgage, or VOR, verification of rent, respectively. Self-employed buyers will need to provide additional paperwork concerning their business and income. Income stability is still paramount, so lenders will want to know the location and nature of the business, the demand for the product or service offered, the financial strength of the business, and its overall ability to continue to generate income. Instead of W-2s, self-employed borrowers need to produce at least the 2 most recent years' tax returns with all appropriate schedules. So, what do lenders consider as the qualifying factors? For starters, they want to see a good credit score. Your credit score is a number that represents how risky it is to lend you money. The higher your score, the better for you. You can sustain a high score by using credit responsibly and doing things such as paying your bills on time and maintaining a low credit card balance. Nowadays, a credit score of 740 or above will enable you to qualify for the best mortgage rates. If you would like to know your credit score, you can get a credit report for free that also contains your credit history. You can review it for errors before reaching out to a lender. A mediocre credit score does not disqualify you from borrowing money, but it could mean worse terms like a higher interest rate or a bigger down payment. Another factor for qualification is your debt-to-income ratio, or DTI, and this one is much less flexible. The ratio compares how much you owe each month to how much you earn each month. The debt aspect includes most monthly bills like alimony, student loans, car leases, credit card minimum payments, HOA dues, and solar leases, as well as the single biggest factor, PITI. PITI stands for Principal, Interest, Tax, and Insurance. Principal and interest comprise your future mortgage payments. For qualification purposes, property tax is calculated at 1.25% of your projected purchase price. DTI does not include expenses like utilities, gas, food, or income taxes. You can calculate it with this formula: your monthly debt divided by your monthly pre-tax income, shown as a percentage. For this, lower is better. Based on today's lending guidelines, an acceptable DTI is generally up to 49% for conforming and jumbo conforming loans, and up to 43% for jumbo loans. The category of a loan depends on the amount, and the thresholds are different for each county. They also change over time. We will discuss loan limits for conforming, jumbo conforming, and jumbo loans in an upcoming video. Now that we have discussed credit scores and DTI, I would like to talk about another important risk assessment, the loan-to-value ratio, or LTV. Your LTV is the amount to be borrowed divided by the appraised value of the home or the purchase price, whichever is lower. To minimize risk, lenders want the LTV to be below 80% for a conventional loan. The rest of the purchase price must be paid upfront as the initial payment, called the down payment. The less you need to borrow, the lower the LTV. If you cannot afford to make a sufficiently large down payment, there are loan options that allow for smaller ones. FHA loans only require a 3.5% to 5% down payment. The drawback is that you must pay for private mortgage insurance or pay a premium until the LTV drops below 80%. Fannie Mae and Freddie Mac have mortgage programs such as Home Ready and Home Possible that allow for a down payment as low as 3%, but with similar drawbacks. Service members and veterans can even qualify for a 0% down payment loan called a VA loan. They are issued by private lenders and guaranteed by the U.S. Department of Veterans Affairs. If you are a first-time home buyer, you can learn about available down payment assistance and grant programs from any mortgage advisor. Home buyers who can afford to make a large down payment are generally advised to do so, but you should not use all your savings. Lenders require you to have a reserve of 2 months and sometimes more of PITI payments. When you have gotten your pre-approval letter, hooray! Now you are ready to hunt for your dream home. Your pre-approval is usually valid for only 60 to 90 days, but can easily be renewed. When you find the right home, you can submit an offer. This leads to negotiations. When you reach an agreement, then you are in contract. Your lender will verify property details with a home appraisal and title search. At this point, you are close to having the loan and moving in. But to get your loan approved, there are still certain things you must do. You will need to provide your lender with the most updated financial information, including bank statements and pay stubs. There are also certain things that you should avoid doing because they can cause your pre-approval to be withdrawn. Remember, the loan approval is based on an evaluation of your current credit, income, debt, and assets. So make sure those do not change. Here are some specific things you should be aware of. First, avoid applying for new credit. This can negatively impact your credit score or your debt-to-income ratio. Second, don't miss any credit card or loan payments. Late payments also hurt your credit score. Third, don't make any large payments or purchases. You may be tempted to start shopping for furniture and appliances for your future home, but paying by credit will affect your debt-to-income ratio and increase your credit utilization. Fourth, if you change jobs, you will have to submit new pay stubs and make revisions to employment and income. It could delay the process or change the amount you qualify to borrow. Finally, avoid making large deposits unless it has a paper trail. If your lender thinks a large deposit is actually another loan, they will consider it as more debt relative to your income. You don't need to worry about paycheck deposits, but transfers and stock sales should have a paper trail. If gift money is involved, ask your donor to provide a written gift letter saying it was not a loan. There's more to the buying process, but having a pre-approval means you're on the right track. With all the tips in mind, I wish you smooth sailing in the process from pre-approval to home ownership. Thank you so much for watching. I hope this video contains information that is useful to you. My goal for this channel is to provide you with quality videos every week. I take pride in making real estate related videos that are up to date and informational. If you have any ideas for my next topic, write in the comments. To support my channel, give a like to my videos and subscribe to my channel. It's the best way to be notified when I post new listings, informational videos, or recorded webinars. To join my next live webinar, add me on WeChat, CocoTanGroup. For the other questions or to schedule a free selling or buying consultation, I can be reached at 408-829-6053 or email me at CocoTanGroup@gmail.com. I will see you in the next video.